IVM.
Welcome to another week on IVM. It's been a great week, and if you aren't following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. On Geek Fruit this week, Tejas and Dinkar discuss their favorite movie soundtracks. On The Scene and the Unseen, Amit Verma talks to researcher and activist Amit Chandra, and they dissect India's education sector. On Cyrus Says, we have writer and director Anand Sivakumaran, who's hosting a great new show for us called Croc Tales as well. Anand and Cyrus talk about how Anand journeyed from an engineer to a full-time writer. On Simplified, Naren, Chuck, and Shriketh go to the root of the word assassin and twisted an interesting history behind it. This week on Shunya One, we're joined by Sanjay Nath, who is the co-founder and managing partner at Blume Ventures. We have a really interesting conversation about investing. On Marbles Lost and Found, Zen and Avanti talk to psychotherapist Alicia Halani. And also this week marks the 50th episode of the Pragati podcast. Hosts Hamsini Hariharan and Pawan Srinath sit down to talk about the long, strange trip it's been and also round up some of the recent news. And with that, I'm going to take you on to your shows. Welcome to episode 62 of Shunya One. Unfortunately, Shiladitya is not in the house today, but let me give you a brief introduction to what we're going to be talking about. We had Sanjay Nath on our episode this week. Sanjay Nath's a founding partner at Blume Ventures. It was a really, really interesting conversation where he spoke about his philosophies behind early stage investing and also some of the challenges behind being an entrepreneur investor, where they're entrepreneurs as well as being investors at the same time. And I thought it was a really fun conversation to get into, and we got some really deep insights around that. Besides that, let me tell you a little bit about what's going on the Slack channel. On the Slack channel, we ran another poll, and we got some good responses on that as well. Priyanka's really killing it with these poll questions. The question was, what do you prefer reading more as a consumer? Reviews, recommendations, a bit of both? And the sarcastic question over there, a listicle once in a while is just fine. And this was in response to having Sucheta on the episode on last week's episode. And based on that, we got some really interesting responses, but it looks like most people prefer a bit of both. Besides that, we also had some other conversation going on Slack. There was Kashyap Jamulia, who was asking the community if they could suggest a tool for easy maintenance of REST APIs. If you do have any suggestions, please do jump into the Slack channel and help him out. And besides that, we also had a interesting discussion between, me and Pinaki, where Pinaki was talking a little bit about how the FIFA World Cup final was not predictable by any of the AI models. And I responded to him a little bit about how there was very little data available. And I uploaded a video, which I think is pretty interesting. It's a Vox.com video about how underdogs perform in different sports, and to what degree luck plays a part, and to what degree skill plays a part. I think it was a interesting test, so go check that out as well. And let's get on with the show now.
All right, today we are here with Sanjay Nath, the co-founder and managing partner at Blume Ventures. Welcome to the show, Sanjay.
Thank you. Thanks.
It's great to have you. It's great to have you on this rainy day in Mumbai. While we are nice and warm inside the studio. Thankfully, Amit made it.
Yes, it was
all the way
easy
here. And of course, I'm sure all our listeners, being entrepreneurs and founders or want to be founders, have definitely heard of Blume. You guys have been making waves as one of the unique venture capitalists over here. But just to, for our listeners, can you tell us how this all came to be? Like personally for you, what was the story as an entrepreneur first maybe, and now a venture capitalist, and the story of Blume?
Sure. So, starting right from the beginning, I'm a Bombay boy and actually grew up not that far from this studio, literally on the border between Khar and Santa Cruz. So it's interesting to, circuit this route all around the world and then coming back to very
very
close to
literally for you this
where
week.
You've grown up. Just quick background. So I went to a school called Bombay Scottish here. Went to Jai Hind College. Then went to BITS Pilani. And interestingly, BITS is not as well known in Bombay because nobody wants to leave Bombay, right? As it's in the south or the north. So spent about 4 years there, and worked for 3 years, and then spent about 15 years in the US. Went to UCLA to the business school, and my first job actually was at Sun Microsystems. I spent about a year, interestingly, which is now the Facebook campus.
Yeah, the original
The original. So I like
yeah.
to say that I was either born 15 years too early or too late, right? One of those. And interestingly, the on the back of the sign is actually, so on the back of the Facebook sign is actually a Sun Microsystems logo.
Yeah.
They've kept that. This is in Menlo Park. So it's very interesting, right? Two different. And Sun was a high flyer, right? At that point.
I remember they used to come to our college with all the, they had those machines like, they used to put them in a truck.
Spark machines, that's right.
Yeah, they used to put them in a truck and we used to see them in college and like experiment with them for graphics and stuff.
Invented Java. We just had coffee, right? That whole, the whole sort of symbol, and then just couldn't find their own way, and then Oracle bought them. But definitely a star at one point, the Sun, and then became a management consultant. Went over to PwC and IBM. But the link before I get into Blume was so. Always lived in San Francisco for about 12, 13 years and always worked on tech projects. So even though it was management consulting, worked on, I remember at that time, HP Compaq. I don't know if you remember, Compaq, worked on that merger.
I had a Compaq laptop actually, yeah.
That's right. And, put that merger together. I mean, helped operationalize that as part of the PwC team. Then IBM acquired PwC and still no connect to the entrepreneurship world. But then became part of the Mumbai Angels, right? Where some friends like Sasha and all started it. I was still in the US and I was an associate partner with IBM. Then I quit IBM and started a legal outsourcing company. It was a little, I think, early days where essentially what we do is we would outsource, litigation, document review, contract research. And the problem, what's different between that and the BPO and IT industry is that in the other industries, you can scale, you get to, you get a $10 million contract, get 500 people, then double that and increase. Here, the minute a case settled, that would drop, right? So it was more like a spiky business. So we basically, merged the assets with another company. But what is interesting is that's the time I was coming to India a lot and became part of the Mumbai Angels. So the legal outsourcing company was a small exit, but, became involved with InMobi. As a seed investor, and that's also where I met my I met my partner and co-founder Karthik, who had similar engineer MBA, had moved back from the US a little earlier, and he was already in India, and we met through that platform. So we have to have Mumbai Angels to thank for that. I will say one of my role models has been my dad, who was a lawyer for about 20 years here. And then, quit that and with two Americans started a software company, a company called Canbay, which did really well, which was, Canada and Bombay, and they mixed the two. And they did well. They did an IP on the NASDAQ. So I kind of helped him, in the early stages, but it's very much his company. But that was always,
it's inspirational, isn't it?
Yeah. And especially coming from a domain where none of his partners do anything about business. And that story was really interesting. He said, hey, listen, with our, with a engineering degree and an MBA and corporate experience, I can definitely do this if he, switched fields and started that. So,
right, yeah.
So that was, so this is about 2010, and now it's 8 years since we moved back from the US. So quite some time back. And so the genesis of Blume was about 2009, 2010 when Karthik and I met, started talking. And I was looking to come back. Now it's exactly to this day, it's 8 years since we moved and about 7 years since we started Blume.
Interesting. And what was the thesis when you put this together, right? So when you're talking 2010, it's still pre-hype era of Indian startups. It's Mumbai Angels existed, of course, but as angels, you invest in across the board, not necessarily just tech. Seed, there was no real tech investor groups, right, which already had put their firmly planted their feet in India.
That's right. I think you're right. If you look at most of the member of Mumbai Angels, and there was a joke that it should have been called South Mumbai Angels, not just Mumbai Angels, right? Because this is basically a group of like well-heeled, really smart kids. I mean, when I say kids, I mean people in the 30s who had spent time in the US, come back, or just successful, second or third generation family offices who had a bit of extra cash thanks to their family backgrounds. And it was something I think that was very noble to start with, because what you were doing is you actually wanted to back startups, but you weren't sure if it was going to make money. So if you thought of a like a typical, South Bombay family with this Gujarati Marwari, they'll say, okay, theek hai, beta hai, paisa le lo, but it's not like play money, but there's no expectation that you'll hit the ball out of the park. And if you fast forward to like Flipkart, of course, it's a skewed example because it's done. But what it's actually done is it's just shown that you can make money in venture, and angel investing is a separate asset class versus something that's just cool to do, right? It had become if you talked about the hype, it had become very fashionable. So one line we like to say is that everybody, their uncle had become an angel investor, and everybody and their nephew had become an entrepreneur, right? Which is very true in the last couple of years. But going back to what Karthik and I were trying to do, when Bazi started, when Avnish and Suvir started Bazi, that was, in about 2001. There were tech and venture groups, but they were all little more late stage. So if you think about it, like a Kleiner Perkins or Sequoia, in the valley where they're backing a Facebook or a WhatsApp, here they're doing like roads and infrastructure and private equity.
Correct.
And because tech in that sense hadn't taken off, right? And so when we said to do it, we said, let's be more like an institutionalized angel fund, which is you operate like a Mumbai Angels or Indian Angel Network, but instead of having a, for lack of a better word, like a motley crew of 40 people making decisions, you centralize that, have 2 or 3 people. But look at seeding these ideas, that are less than 500,000. So there were very few groups, institutionalized groups, that looked at early stage venture.
Correct.
There was venture, but it was not early stage. It was more growth and
established
That's
companies.
right.
Only,
That's right. And I think another part of the vision also, Karthik had moved back a little earlier, is that if people ask us that, the Valley is, such a comfortable place, or the US or anywhere overseas so comfortable, like why wouldn't you stay on and do it there? I think there was definitely a burning desire and passion to come back and seed companies here, because otherwise you just become like scores of Indian Americans who move there and, are charting out their successes there.
Right.
And there was definitely a burning desire and passion to do that back home, to do that closer to home.
Was it is it the cold opportunity of it, or was it more of a kind of emotionalist that I want to do something in India?
That's a good.
Or is it a mix of both?
I think it's a mix of both. In my case, my brother, who's an investment banker on the personal side, had moved back from New York, and I was very intrigued. What I found really intriguing is I found a lot of Indian Americans moving back. And then I said, I've got a decent amount of resources. I'm from Bombay, and also, PwC was interesting. I was an associate partner, but when I moved to IBM, it's like the hit by a bus syndrome, and I realized that in IBM, if I get hit by a bus, nobody would even know, and nobody would care, because you have 300,000 people.
Right.
Yeah.
So that impact wasn't there. So I think that coupled with India was opening up. I remember, so this was quite pivotal. I remember going to Berkeley, the business school had an Asia conference, and they had basically Indians and, mainly Asian students, Indians and Chinese, and Arun Sarin, who used to be the chairman at Vodafone then.
Okay, yeah.
And I remember one of the students standing up and asked him, Mr. Sarin, what words of advice or what words of wisdom do you have for us? And he said, he's playing to the crowd, playing to the gallery. He says, young men and women, I have 2 words for you. Go east. Right? And I'd already made a decision to come back, but I think what is interesting was that really rang true. And there's a very interesting graph. This guy on Twitter, this guy called Vala Afshar, he's the chief digital officer at Salesforce.com, and really interesting tweets, a lot of data. And he's got a very interesting, there's a circle that is drawn from the UAE, Dubai, China, Southeast Asia, India, all around it. And half the world's growth is in that circle, and half of the world's population is in that circle. It's a small circle, and it's very fascinating, right? So what was largely saying that if you're moving to this part of the world and you have India and China and Southeast Asia and Middle East, 3 billion of the world's 6 billion people are in that circle, right? So think of the opportunities and growth, and that was very interesting, as opposed to, if it stayed in the valley, you could do it, but there are so many people there. So the idea, I think, was to be the best and really seed the next wave of startups here. We were talking about Bombay earlier. Karthik's originally, not from Bombay, but now Bombay's become home. For me, it was coming home. Bangalore is, sort of the Silicon Valley. But interestingly, most of the seed funds, whether it is K Capital, us or India Quotient, interestingly, we're all in Bombay.
Yeah.
And Rehan also, if you add.
Yeah.
So I would say that for a startup, it's very important where you are. But I think for a VC, it's a little easier to travel.
Correct.
Next 2 days, I'm in Bangalore. Next week in Delhi. So it's a little easier.
Yeah, you have to obviously go where the action is and where to find those.
More than half of our portfolio is in Bangalore, right? So it's not.
That's not surprising at all.
Yeah.
We talk about that all the time, Bombay versus Bangalore.
Yeah.
The thing that I think comes out most often is that it's tough to scale in Bombay from a tech perspective.
Monday to Thursday in Bangalore, Friday, Saturday have to be in Bombay. so that's
actually a good way to put it.
That's a good balance of life.
Yes, indeed. I know a lot of Bangalore entrepreneurs who actually envy that of Bombay.
A lot of Bangalore entrepreneurs will say, my secret is to do it, but to have some Bombay connection to spend my weekends in Bombay.
Yeah. Meet investors maybe.
No. I'm just saying in terms of
Just
like fun stuff, right? Just because of what Bombay is.
Of course. But going back to when you guys started and put this together, obviously the thesis was there and opportunity was there. You knew that this is coming up. When you actually went in and did your first investments, how long did it actually take to find, in your definition, something worthy? Because you're going into uncharted territory at that time, and even now the risk which you carry at an early stage is different from all the others, institutional funds. So how did you all actually do it? Like your first few, and they have been successes also from those first few, right? Many of them you guys have.
When we first started, that's a really interesting question. The thesis and the idea always was to be a institutionalized angel fund, but operate at valley pace, right? In the sense that not take 3-4 months for a term sheet to make a decision, the traditional IC, but move quickly, right? So have the agility of an angel, without the bureaucracy of a group, and then move fairly fast. Right. But it's an interesting dichotomy, in your question, where in one sense you're a little very cautious because it's your first deal, right? So it has to be perfect.
Yeah.
On the other hand, you're actually quite anxious to make it because, the way our business works is that you typically, if let's say somebody's trying to raise, 50 million, you do a first close of 10 million and you have to make investments in that because your, future investors want to see. So in that sense, there is pressure to make an investment, right? So it's that balance, yin and yang of making it quickly to show some impact that you're doing something with the money, but yet it's got to be perfect. So, and I'll say this, one of the first companies we looked at was a very interesting company, which we didn't do, called Idea Forge. So Idea Forge, they make, they're out of IT Bombay, they make these drones that the Department of Defense, here in India, can use, and UAVs, unmanned aerial vehicles. And at that time, we weren't that comfortable with the government being such a large part of the business. Right? It's your first investment, right? But really, like the team, today they've done well. They've raised a lot of money. And Ankit, I know him, have a lot of respect for them. They've actually done well. I think that was one of the first we looked at. But you're right, Grey Orange was quite early. Carbon Clean Solutions was quite early. I think when you start, you're getting, whether it is Karthik or anybody, you're getting to know one another, how people think. It's like a case study, right? You can talk in the air, but when you have something in front of you, you react, right? What do you like about this entrepreneur? So I think we figured that along the way. The first fund is typically what's called like a learning fund.
Right.
So by learning fund, you'll hear sophisticated investors. The first question they ask you, okay, what mistakes have you made? Right. It's like a serial entrepreneur. Why do serial entrepreneurs get backed? They'll say, okay, we want you to have made mistakes. Right. And we want you to have made the mistake on somebody else's money, not on their money. So make your mistakes, come and learn. So by the time you come, and a big part of learning is what not to do. Right. So the first fund in one sense was a learning fund. Typically, it's not institutional. Institutions typically don't back first-time fund managers for the same reason. Two people are going to get together for the first time. They are working together for the first time. They've not made investments. And the second fund is, when they've made mistakes. Right. So just segueing, I think one of the first slides and a very important slide of Fund 2 deck is the lessons learned from Fund 1. Right.
Ah, interesting.
And we used to put it out there. We actually put it out there. And talked about, we went in the sense a little wide. You don't have enough classic question. The classic issue is you don't have enough in your winners. The companies that are doing well, you don't own enough. Right. Yeah, I mean that was 2011, the first one.
Okay.
Yeah.
So can you expand on that a little bit? I mean, like, what was the? Why would they say that you don't own enough of the winners? That
So if you think, let's take an example like Flipkart, right?
Mm-hmm.
Now, okay, Flipkart's a $20 billion exit, but let's say it's even $2 billion, right? So if you're an angel investor and you come in, then the stakes matter less because you've come in very, very early
Right.
and you made a very high multiple.
Right.
You may have, invested 10 lakhs and you may have made 20 crores, which is fine. But if you're a venture fund that comes in and you don't own enough, what happens is you spread your bets wide.
Right.
And not every company is going to be, created equal and do well. So what happens is if you kind of be a little democratic and you spread across, then you need to have more money when your company start doing well.
Oh, okay, so that you can reinvest at that point. Okay, all right,
Absolutely,
okay,
you got it right. So at that time, if you've blown all your chips and you don't have chips on the table,
Right.
It's like I don't play poker, but I know it's popular. But to use one analogy of cards and poker is that, there's a guy who's just sitting, and the minute everybody's cleaned out, he puts his chips on the table, and he takes the table in that sense. So the secret of venture capital is obviously to find those winners and to go deeper in those. And then it comes, honestly speaking, there's a very interesting story. I remember Jim Breyer, who backed Mark Zuckerberg, Jim Breyer was then with Axel, and I think it goes something like this. I think he was asked that, did you know that Mark would turn out to be a $100 billion company?
Correct.
He said, "Not did only I not know, even Mark didn't know."
Yeah.
Right. So you kind of discover it along the way, and the idea in venture capital is to have the capital to go deeper, and good founders want you also to go deeper. They want that support, right?
No, if you've worked well with somebody and you want to kind of...
But then capital is the raw material. So
that is true.
I mean, they want your support, but you're in the business of, supporting them with capital.
Yeah, and interestingly, one of the things which came out here, which maybe a lot of folks don't talk about, is that even VCs need to gather that capital in the first place. It's not that there's an unlimited purse somewhere, and you have to pitch that. So you're literally, as an entrepreneur, when people pitch to you, you're also pitching to the folks you're representing.
That's a really interesting point. I mean, today I'm dressed, like an entrepreneur, but what's interesting is an entrepreneur can pitch to a VC and wear whatever he wants. But the VC has to be in a jacket or a suit because you're going, to all these formal offices. That's very interesting that a lot of industry and a lot of people don't know how we raise money.
Correct. Right. Correct.
And we actually talk about that, and the number of times we get rejected.
Yeah.
I've talked to a fund manager who's raised $1 billion. And I remember Karthik and I started. I was in Singapore and visiting him, and in nice office, great guy, very simple guy, and they've raised $1 billion, right? That's a lot of money. That's 20 million in fees.
Yeah.
Every year. And I said, wow, give me some gyan. I mean, you've done well, and all that stuff. And he says, I can't tell you that of 10 meetings I've had, every 10 meetings I've had, 9 people have thrown me out of the room. In the sense, not bought my story. Okay, now there's somebody who's raised $1 billion.
Wow.
And even then, I mean, he may be exaggerating, but let's say 2 out of 10. For him, also the hit rate is 2. So just think about it, right? This guy's an established manager, had made one of the best, known investments. So that's and Karthik's, I think, written a long blog, I think, on this, which is very interesting about. It's we get calls from a lot of fund managers, potential fund managers say, I want to start a fund, let's talk. And we say, let's have a lot of drinks and then let's talk, right? Because it's not for the faint-hearted. It's tough. It's a long-term game, and it's not trivial.
But so, I mean, I think that shows the value of persistence for everybody, right? Whether it is at the VC end or but actually, you were talking about a little bit before we started about how you guys are more entrepreneurial. Or do you want to come into that in the second half?
Yeah, we will. I think we should. It's a good time to take a quick break.
Let's take a break and then let's talk about the entrepreneurialness of VCs.
Yes, absolutely.
Hi, I'm Vishal Gondal, an entrepreneur. I've had the chance to meet and understand how some of the super achievers have hacked their way to success, and they have done spectacular innovations. Now I take a closer look at these people's lives to find out what lies beneath the force. only on The Vishal Gondal Show. Episodes out fortnightly on Wednesdays on the IVM website, app, or your favorite podcasting platform.
All right, welcome back. I think we got into a very interesting side of the conversation around what most people don't know about VCs, thanks to Sanjay. And it is actually more like being an entrepreneur yourself, right? I mean, that's what you were asking
exactly.
as well.
When we were talking earlier, you were discussing how the VC business people look at it as something, whereas it's actually fairly entrepreneurial, especially when you're running the kind of fund that you're running, right? So why don't can you tell us a little bit more about that and how that plays out?
Sure. No, I think you're right. I mean, we always separate the entrepreneur fund managers, let's say, from great brands, but where essentially they're like a managing director, but they might every 5 years they might shift from one job to another. I think there's another level of complexity that separates entrepreneur fund managers from regular entrepreneurs. So just let's look at two examples, right? I mean, let's say Shiladitya is an entrepreneur and coming and pitching to a VC. You kind of what you see is what you get, right? If you're, let's say, building something on the mobile app space, you can show me your demo, I look at it, and if there's a fit, either it's a yes or no, or there's less gray area.
Right.
Here, essentially what you're doing, especially if you're a first-time fund, you're actually saying that, I'm going to go out and raise, let's say, 50 million from, you don't even know who you're going to raise from. You don't even know where you're going to invest in. You have a kind of broad idea of the thesis, but essentially saying that I'm going to go and invest into, a sound app or let's say an audio platform, and the profile is that somebody that looks like a Shiladitya, brand new painted, but you really haven't found them as yet. So it's a very high-level concept sell, and there's a lot of conviction. But the investor on the side really has to back you, and this has got to go through another level of due diligence, because it's not only a concept sell. In a sense, you have what you're really painting is a picture of the future, right? Versus an entrepreneur, at least you can relate to the team and what they're building, right? So
and there's also sector you can choose, or you pitch a sector, or you pitch a very broad, basically definition.
That's right. So which is why for first-time fund managers, the hill or the bar to climb is very high, because if you don't have a track record, you might be a great angel investor and you may be really brilliant management consultant or iBanker, but if you don't have the track record, the other person has to really do a leap of faith. So which is why the first people who back you are really your deepest supporters, because they're backing you, right? Yeah. So it's very akin to backing an entrepreneur where you really back the founder. You're not sure what they're going to do, but they're going to say, let me put, let's say, about, let's say 100K, 200K. And if, once they're past product market fit, then I'll put another $1 million. So I think the entrepreneurial journey of the fund manager is very interesting. It also tells you a lot about yourself, because I'll say, one of the most humbling experiences is that to go and ask people for money.
Mm-hmm.
And
you're humbled many times.
And you're doing it, and you're doing it again and again.
Yes.
And you're doing it very often to maybe people in your peers. You may know some of these people socially, so you have to have a lot of conviction, and with that comes responsibility. Mm-hmm. But what is really interesting is that once you get past that initial barrier of the first close and the first set of investments, and then people actually want to know, okay, you have some skin in the game, you're doing this full time. And this is really interesting, because one of the most interesting parts about like what Karthik and I do and what Blume does is that now we're in our mid-40s, right? I mean, right between 40 and 50, that you're learning every day, every other day from people who are either half your age or who are much younger than you, and you're learning about new things every single day. Right, as opposed to being in a corporate job and making a lot of money, but you're essentially doing the same thing again and again. That's one. The other part is when you even go and pitch to investors, what is interesting is they're looking at this vehicle like a Blume or a fund as not only making money but also getting involved with their time.
Right.
And I think getting involved with time is very special. So we find a lot of, so for example, the first fund, many of the kids or the sons were, had to come back from the US or from wherever, and they found this also a way to get involved. Mm-hmm. So I think the level of engagement in early stage makes it very exciting also to be. Besides the kicker on making money, which of course has to be there.
Right.
It's, people want to be involved with that, right? I mean, success has many fathers or mothers. For example, at Flipkart, the people that were initially involved, it's a really interesting feeling if you were involved and got to see this, come up. So there's an intangible kind of feeling when you're associated with a fund or a startup,
right.
and we were able to tap into that.
Right.
Got some really interesting family offices, successful entrepreneurs to become mentors and advisors to our network.
Right.
In fact, that was also one of the defining differences you all were playing for, and I want to ask you about why you chose that route, because one is just doing early stage investments, and similar to what angels do, maybe a little larger checks. But angels are essentially, here, take my money. Hopefully this should work. Let me know if you need any help, but I can't give my time, right? So much. Or at least that's not the expectation from most angels. You guys, again, early stage fund could have been just great. I'll do my digging, we'll find really great people and we'll invest. And we'll channelize the angels into one single kitty so that it's, all that is streamlined. But you also chose to double down on the operational side, right? You're one of now, especially over time, you all have become very operational when it comes to enabling your investments. In terms of, I think, legal and a whole bunch of things.
Yeah.
So what made you go down that route? Did you see that as one of your edges?
Yeah. That's an interesting question. I think one of the first visits when I remember when we had moved back from the US, we'd still not in San Francisco, we'd still not sold our home. So one of the first times Karthik and went back, there was no furniture and we went and stayed in my house. I remember this was 2009, 2010. And we met quite a few quote-unquote platforms, right? Like Techstars, 500 startups to kind of just learn, right? That first period is discovery. You're learning on what's out there. And one of the first ideas was to maybe bring like a Techstars to India, right? Okay. And represent them. So the idea of the platform in one sense was always there, right? Okay. That investing is much more than capital. You have to help founders in many ways, right? So that was at the back of our mind. But we didn't want to transplant like a copy-paste model. We said, let's create something new. The others also, I think, good entrepreneurs or fund managers or anybody we all have to, at least we realize that what we're really good at and what our gaps are. So both of us, unlike some other, typically value funds where, if you go to a value fund, they are like a partner has just done like storage for 15 years. Somebody else has just done internet. They're deep domain experts and they only look at that, right? Yeah. Like healthcare, you would only go and talk to a partner. We were a little more generalist and we are both not the classic serial entrepreneurs. So we said, let's be very clear who we are and then let's try and fill that talent and bring in others, like let's go to, the likes of Deep Kalra for travel, now Raghu at Taxi for Sure and Ola, they become mentors. They're people like that. Let's go and so they can, we can give them the general business advice, scaling up, fundraising, but in terms of like let's say your industry, content or media, you want to get somebody who understands that, right? So that was always part of the plan. And then along the way, we've actually now today, we have an organization entity called Constellation. Okay. So we've got a Chinese wall. The Blume team is about 10 people strong. Karthik and myself, a CFO, and then we have principals and analysts. And then the Chinese wall, a dotted line. On the other side of that, we have our CFO who has about 30 junior CAs and company secretaries who do all the legal corporate work, term sheets, Singapore incorporations, Delaware restructurings, interface with US, Singapore lawyers. We have a team of 5 Sanam and five ladies, 5 people who help all the companies with recruiting, and that's a tremendous help. Founders find that, and I have you talked about capital, right? So I'm saying this in half jest, but it's true. There are 3 kinds of angel investors, right? There is like smart capital or venture and angel. There's smart capital. There's dumb capital. So smart capital, obviously, which is your, besides capital, you're adding value in a lot of ways. Dumb capital is, actually realize dumb capital is not a bad thing where somebody just gives capital, doesn't have the time. It's not a bad thing because let's say there's a CEO of a P&G or Unilever who happens to be an angel investor. He's going to be extremely busy. Right. He's helped you and you can tap him when you need it. The third is what I'd call like nuisance capital, right? And I think it's very important because what I'll tell you what's happened is I think because there were also so many angels who rushed in.
Correct.
And there was so much money. There's so much money in Bombay, South Bombay, wherever, right, in India. That somehow the entrepreneur, also there was a sense that entitlement, the entrepreneur gets obligated that, okay, if I've given you money, then you have to service me.
Yes.
Versus a good angel will say, okay, I've backed Shiladitya, how am I helping you?
Yeah.
If I help you, we're all going to do well, get rich, right? And of course, and you'll create something of lasting impact. Versus, what are you doing for me?
Right.
And also, sometimes you get obligated, like, let's say, if you give me 10 lakhs and you give me 1 crore, but your advice might be 10x more valuable than his.
Right.
But he's giving me 10 times more money. He says, okay, so, there's an obligation that comes with the advice. I think that is very important for entrepreneurs to watch out for, that all money is not created equal.
Right.
That it's like a partnership, and I'll segue and then I'll stop. I remember, and this matters more in the US, but I like to keep on going back and saying this. Before I moved back to India, I remember I was in Palo Alto, and there was a large conference room, and somebody asked a question that, what analogy would you use? What is the dynamic between an investor and the entrepreneur? I'm saying wife, but it could be husband in this case. Which way? So he said, so this guy, said, how many of the people in the audience are married? So quite a few were married. So he says, VC is more important than your spouse, more important than your wife, right? Because in America, which is true, in America, the average marriage lasts 5 years. So he said, he really said, he says, after your wife has left you, I'm still going to be there because it's going to take you 7 years to exit. And the reason that still rings my mind is that it's a very long-term game.
Yeah.
So we tell entrepreneurs, be very careful of who you take money from. It's not just the investor doing due diligence on you, it's also you're doing due diligence. You're a partner. You're sitting on the same side of the table. Shit's going to hit the fan and you want to be through. It's really like a marriage vow. That's exactly what it is.
Yeah, interesting. And that's because the whole term which you're talking about, especially for a VC who comes in institutional, unlike angels, right? Angels can come in and your next round they could say, I'm out. Right, although the good ones will probably not want that. Yeah. But for a VC, in fact, that's an interesting point as well. For a VC going from early stage, what is a good exit for that kind of stage, right? Because eventually, coming back to the earlier point about not holding enough in a company, which tends to happen because you guys, although you've taken the risk, but not a angel type risk, you've taken a little lesser risk than maybe the angel. But at the same time, you are not getting as big a seat in the table as the upper guys may later on maybe.
Yeah.
How do you balance that out? What's the metric to make sure the ones you bet on which are really doing well don't go out of your hands with all the support and effort which you've put in at the early stage?
Yeah. No, that's a great question. I think there's no one perfect answer, but a couple of responses. I think one of the problems that India has had traditionally relative to China or the Valley is that we've had a lot of paper exits, paper money, and not enough cash. And what happens is, if you have cash coming out, more cash goes back. And I'll give you an example before coming back to India. In the Valley, usually most of the, I think there's some stat that says about almost 70 to 75% of exits happen between 100 and say $300 million, right? 100 and 400, a very large percentage. And they also happen quickly. They happen in 4-5 years, maybe 5-6. So which means there's a virtuous cycle, which is healthy, because if you've given me money and return it, you're going to give me money the second time, right? Which India has not seen. Yeah. So one of the, as angels, one has the advantage of you come in very early. What one can do is, or like a small seed fund, how we started, just take back the principal that you put in and you still stay in for the upside. So for example, let's say somebody's invested 10 lakhs, right? And the or 50 lakhs, and let's say now that's worth let's say 5 crores,
right.
And there's an option to take some secondary. You return the principal, so that way you're square, and you're still in for the upside, which a early angel investor would have, whereas the VC would not, because they typically come with 5 million. You can't take 5 million out. You have to wait, right? So sometimes coming in early has an advantage, and you have some angel funds in the Valley, right? Ron Conway of SB Angel, And even Dave McLeod of 500 Startups, that's how they basically started very early. So, and I think India needs to, we need to have many of these, what we'll call, Flipkart is a sixer that's hit way out of the park, right? I think we need, out of the stadium, I think we need lots of ones and twos and threes and many more of them, because that will see a lot of cash coming back in and cash going out.
No, exactly. Also, I think I remember hearing something about entrepreneurs who exit do a lot of investing. And so I think that also kind of helps a lot.
Like angels again.
Yeah. No, but I mean, like if you can you can start seeing more smaller exits rather than just the mega exits.
I mean, think of it. It's not that different from like a stock market, liquid stock. Let's say somebody is in and out, and what are trading? Traders are in and out, right? All the time. I mean, they've got that cash. Usually, they put that back in.
Right.
Yeah.
Of course, they may go and buy a house or a car, but the fact is that if you see something works, you do more of it.
Exactly right.
So I think smaller or earlier investors, including venture funds, can do that. But then, like you brought up a great point, the further up the stack you go, you've got to play for keeps and play for slightly longer.
Correct. Yeah. So then that's the hedging which anyone in the early to middle to large stage funds do, right? They always, and of course, the larger the fund or the larger the investment you have, the larger expectation from the entrepreneur also.
Yeah,
but also I think as the larger the investment gets, the risk profile also kind of decreases somewhat, doesn't it? I'm just guessing here. I don't know. You would know better than me, but I would think
that is true. I mean, if you look at the risk return continuum and you do a graph, it's obviously the earlier you are, the highest. Like I'll give you an example. Typically, venture funds are 10 plus 1 plus 1, means the 10-year life funds and extendable by 2 years. So you're talking about 12 years.
Right.
If you're a growth stage fund, you might be a 7 plus 1 plus 1. And if you're pre-IPO, like 3 plus 1 plus 1, right? But then your of course, the return, risk return is much smaller.
Right.
So what you're really aiming for when you come in early is you're trying for that Flipkart to come in very, very early, right? I mean, to come in at a $2 million valuation and take it to like a 20 billion, right? Very, very, very early. And to make up a 30-40 investments and find one Flipkart, then one Paytm, one Ola, and then it's like a inverted, it's like a pyramid.
Right.
Yeah. Interesting. So, I mean, before we wrap up, I actually have a quick few questions which just came to mind off the top of your head, right? Since you've been doing this now for 8+ years, you've seen India startup situation very early. You've operationalized and helped so many startup founders and companies. Of course, had so many exits as well. What are some interesting things which come to mind from like what not to do? What should entrepreneurs not do? What have you really seen? Things which have gone bad or things which have not worked, and the lessons learned, right?
For example, somebody calling you not a human being.
Yeah.
So the early lessons learned, whatever you can share, right?
Yeah.
Insights from, because you've been so high touch with the people you've been involved with.
It's interesting. Again, I'll contrast with the Valley. Not to say that Valley entrepreneurs are better, but they've just done that more. And I think one of the things is that you look at founders, and we all have egos, right? I mean, the positive side of ego is that the confidence and the optimism, and that makes you different from everybody else, right? For most people who just have corporate jobs, I think one element, since you asked a specific question, I think one of the elements is if founders can recognize their gaps earlier and be very clear and upfront. The investors, again, it's a marriage, right? So they actually, in a board meeting, we actually want to know, okay, all that's going well, that's fine. Tell us what's not working and tell us where we can help. Because if something is working well, you're doing it already well. We don't need to hear about it. So I think the inability or unwillingness to build a team or to hire a co-founder and say that I can do it all, I think those people issues, I think, are the biggest. To hire somebody just below you, right? The founders. And I think, so I'll give you an example. The Valley, for example, you'll be sitting in a cafe and you see the guy's card and you say, oh, when did you start the company? He says, no, I didn't start it. I'm the president, but the VC brought me in. The co-founder is now a chairman and I'm the CEO. There's that willingness to step aside if you're not the right person. Right. That's not to say that CEOs should step aside, but I think the willingness and the openness to recognize gaps and fill it, you can still be the largest shareholder, right? So I think that's a big one. And I think just asking for help and communicating. So it's interesting. Both the points I'm talking about have more to do with personality and with people.
Yeah.
We're not talking about technical skills.
Right.
So I'll give an example. There was this guy called Michael Marks. He was the co-founder of he was CEO of Flextronics, which is a large contract manufacturing company, and he's done well. And he was in Bangalore some time back at the Ritz-Carlton. I think the Rahul Sachitanand from ET covered him. And he said, what's the definition of entrepreneur? He said the entrepreneur is somebody who believes in something that nobody else believes in.
Mm-hmm.
That's the first ingredient. But can hire and carry other people to believe in that. That second part is also very important. You can have a brilliant single visionary. We've seen that in some of our failures. The guy is just off the charts intelligent. But can you bring in others, and can they work with you, for you, with you, to believe in that, right? So I think that we've seen is one of the biggest things. That can you bring others to buy into that and let them World Cup football is going on right now, no? It's a team game, right? You're the captain, but our cricket, can you bring other people to see that? Awesome. So we find a lot of people fail there.
Yeah. So that's being real with yourself and being a good people person, I think, is fundamental skill then.
Yeah.
You mentioned hiring a co-founder.
Mm-hmm.
Right? That is something that I've heard a little bit about, but that is not something that,
most founders would hate that idea.
No, I mean, it sounds weird, right? Hiring a co-founder, right? I mean, the word founder means the person at the start, which, and again, I've seen this happen, right? I've seen this happen in a couple of companies and stuff like that, but it always struck me as kind of, and I'm not hung up on titles, but it just struck me as kind of like this strange thing. But I mean, you said that
I think that's a really good question. It's a very difficult thing to crack. I remember there's this thing called Young Entrepreneurship Association or something, I know, in schools. And I remember one of the kids, this kid was 14 and the other was like 13. And they were presenting, and he stands up and says, it's really funny. He said, so they were asked to introduce themselves. He says, I'm the founder. And he's the co-founder. He didn't say like you normally say we're both co-founders, right?
Yeah.
It was very funny. Founder, and he's the co-founder, like a co-pilot, not right? So we've decided today that we won't max single founders, and I'll tell you why, right? The single founder may be brilliant, but at the end of the day, the CEO, like Karthik's and my job, if you think about it, is very lonely. Right? It's very interesting. You get people like us and everybody to share things with you that you may not even share otherwise, right? Because when you're at the top, if you're a co-CEO or whatever it is, you need a sounding board. Mm-hmm. So you might get a good board of advisors and everything. But they're not really working with you in the trenches and when things are going wrong, right? You can go to them. But on a day-to-day basis, right? Who do you go to when things are not going well? And that's what a good co-founder does with different skills.
Right.
So when I say hiring, in the sense that finding that co-founding team is very, very difficult, and there's no single answer. Like the IT, the Flipkart guys, they just went to the same hostel in IT Delhi and they started.
Right.
People want to find that magical thing. You should have worked for at least 10, 15 years together. No, that doesn't happen.
Right.
I think it's personal chemistry, it's luck also. But it's, and 4 I think is high, 4 is a lot, 2 or 3 is fine, and there is no perfect answer, but I think finding the co-founder is probably the single most important thing that a founder can do. If you sometimes it happens, and it doesn't have to be equal stakes, by the way.
Right.
You could have one main founder and another, which is also fine.
Okay, interesting. So it's a interesting.
It's a reality check of the willingness for entrepreneurs to absorb this kind of input, right? They should know that you can't do everything on your own, even though you're the best, most confident person in the universe.
I mean, look at it. I mean, I'm a huge Messi and Barcelona fan, right? I mean, Shiladitya knows. But it's exactly the same thing. See what happens to Argentina on the field. Just doesn't have that support there. Right. Whereas Barcelona, he's got it. They're right at the top. The same guy.
Same thing with LeBron and the Cleveland Cavaliers. He had to leave. Sorry.
The same thing. It's exactly the same thing, right? Can you think of those people as your co-founders and who can feed you the ball so that you can go and score, right? You're the same guy.
Yeah, true.
And it's the same analogy.
Cool.
Amazing.
Awesome.
That was, on that note, this was a great close. I think we got a lot of good inputs for all our listeners, of course, and I hope the entrepreneurship industry at large. Where do people get in touch with you, Sanjay? On Twitter, maybe you can tell us your Twitter handle.
I think Twitter's fine at Sanjay Nath. And we'll take it from there. I mean, we're very open. I think what I know Karthik jokes. I think he says he has about 1,000 LinkedIn invites that he's not opened, right? So I think one of the things that we really is just time and managing that. And, if we think of like the Blume portfolio as our family, we don't get enough time with our family. And then you want to be supportive, but it's just... just finding the time to do that. So it's difficult. But what I'd say is, I think the medium that y'all are creating is fantastic. Would love to engage, because if there's a platform where, you can reach and create something that's engaging and go back like a tweet storm, a tweet thread, or something that's interactive live, I think that's great. And we would love to have many of our peers on this and entrepreneurs also.
I think we'll figure that out. I mean, we'll start getting. Oh, you got a lot of good. See, there you go. You got 100 guests.
Yes, and we have a Slack channel, of course,
which is available on ivmpodcast.com/Shunya One. There's a button over there that says joining the Slack channel. Send us your email address, and we will hit you back with an invitation. And also, please remember to send to do ratings, reviews wherever you're listening to this. iTunes reviews particularly help, and that's it.
All right. Thank you so much for doing this.
Of course,
Sanjay.
Pleasure. Thank you so much. Thanks.
Why don't we talk about mental illness? For that matter, we don't even talk about emotional wellness. And if we can't talk about either of these basic, very basic aspects of being human, what do we do when we just feel like something's not right?
Hi, I'm Zain.
And I'm Avanti.
And this is Marbles Lost and Found, a show where we invite conversations about mental health and illness and just get people to talk about it, because it's okay to do so. Catch Marbles Lost and Found every Tuesday on the IVM app, website, or anywhere you get your podcasts from.
Yeah. It's IVM here, let's go. We the IVM kids on the block over here. Just to talk, taking a break from producing all day. Coming on this podcast cause we got stuff to say. IVM Daily is the name of the show. Monday to Friday, we ready to go. Talking about stuff in our head. We might even talk about our favorite bread. Signing out, it's IVM here, the podcast network that's in your ear.
Catch IVM Daily, Monday to Friday on the IVM Podcast app or wherever you get your podcasts.